for another year, we are maintaining the outlook on the global reinsurance segment as stable. And this is not because we think that nothing is actually changing or that the factors are remaining stable on their own, in isolation. On the contrary, we think that there is a very high level of uncertainty, but a number of positive trends, such as price improvements, are being actually counterbalanced by several negative ones. So let's start with the positive ones. I think that there is not a secret that the market conditions on the pricing side have been sustainably improving for the last 5 years. So following the Nat Cat events in 2017, there has been this steady increase in rates. There has been some questions about their adequacy, but definitely that process has been accelerating recently, driven by the accumulated cat losses, increased frequency and severity in the last 5 years, and more so because of the latest events related to Hurricane Ian. But not just that, we also saw during the mid-year renewals in Florida some early signs of dislocation in the market. And we believe that towards the 1/1 renewals, that level of dislocation is going to continue and going to intensify. There are particular pockets in the market, aggregated covers, lower working layers, particular perils, where simply companies, investors don't want to deploy capital regardless of the price. So I think that that is creating very, very attractive market conditions in terms of pricing. Now, having said that, the problem is that we don't see that new capital actually forthcoming. So one of the things that we have observed in the market as well is that it has remained very well capitalized. That is something that we have said in previous years. So it's not like in previous cycles when we had a significant event which actually wiped out a significant amount of capital. Now, the difference is between available capital and dedicated capital. And companies have been very cautious on how they deploy that capital because of the difficulties in actually meeting, of generating ROEs that actually meet the cost of capital. So we have seen this shift away from property cat, more into casualty lines, primary lines of business, E&S, specialty. That continues. So a number of companies have started to stabilize results. But because of that, still there is an extreme level of caution on how they deploy capital into new into cat risks. Well, market conditions are likely to continue. Say, pressure on pricing, we think that is going to continue. For the renewals in January, I think that it's too early to see any new capital coming. Say, we have seen very, very small signs of that happening. Say, hopefully we'll see that during the year. At the same time, I think that underwriting discipline is likely to continue because companies still need to meet the cost of capital and generate those ROEs that they haven't seen during the last 5 years or even more. And I think that long term, actually, there is a big challenge for the industry. See, at the moment, declining cover or reducing their participation in certain areas of business, such as property cat, is probably the most rational way of managing their capital. But going forward, what we see is cat risks are here to stay, and we have new emerging risks, such as cyber, for example. We see an economy which is more dependent on technology and intangible assets. So innovation is something key that companies need to get into to participate in a market which is becoming more complex, more diversified, and to maintain the relevance in that broader economy.